All right, welcome to the On the Tape podcast. Happy to have Peter Boockvar back on, Chief Investment Officer of Bleakley Financial Group and the author of the book report, which I read every day, which you can find on Substack. Peter, welcome back to On the Tape.
Thanks, Danny. Great to be here again.
So you kind of came on when I relaunched this On the Tape. I think you were guest number 2, and it was February 18th. We recorded kind of in the afternoon, and we released it on the 19th. February 19th was the actual high in the market. That was the all-time high in the market. And you had a theme at the time that you felt, and just watching all the kind of undercurrents of what was happening, that the Mag 7 were in for a retreat, that the dollar itself, which is what people were using as an excuse to park money here to be exposed to US dollar, you felt it was toppy. And you nailed it literally to the hour, to the day. So we sit here now, nothing's happened. We're right back basically 2.5%, 3% off of that high number. So I know nothing's really happened in the last few months since you've been here, but let's talk about kind of what led you, kind of remind people what led you to that theme in mid-February, what's happened and where we are today.
So watching the Mag 7, of course, had to be a do for any market watcher. And I felt like going back to last year when all the Mag 7 names, well, put aside Tesla, focus more on, the AI tech trade. It seemed that the second quarter earnings that were reported last July, along with other research reports, particularly out of Goldman, people started to question, okay, this AI is really cool, it's amazing, but there's an enormous amount of spend, and what's going to be, sort of at the end of that yellow road. So I thought that the market started to sort of differentiate amongst those big names. In fact, Microsoft peaked in July of 2024, right around this, because Microsoft was a major spender, and people started to say, okay, well, this very cash-rich flow generative business is all of a sudden becoming more capital intensive. So then fast forward, NVIDIA was still winning and Meta was still winning in this sort of race. But then the DeepSeek news came just literally 3 weeks before we had our pod. And I thought, okay, this is potentially the end of this AI tech trade, not in terms of those stocks not working, but in the sense of them not being the market leaders to the extent that they've been. And at the time, at the peak, you're talking about Microsoft, Apple, and NVIDIA, $10 trillion of combined market cap, which was 10% of global GDP. I mean, the numbers just got so astonishing, and I felt that the size, the valuations, and now you had potential catalysts, that maybe this trade was not taking a rest, but maybe was over. And being a student of the markets, we know you have these 10-year time frames where a particular group just dominates, and then it passes the baton off to something else. And I thought that this was the baton pass. And then, of course, I went back and I started to look at the international holdings of all these stocks, and they were extraordinary. And this trade became not just popular with U.S. retail and institutions, but it was a global trade. It was, okay, I have dollars and I'm based in Europe, and where am I going to park these dollars? Yeah, treasuries, I've always had that as a choice. But the Mag 7 became this reserve asset. And to the point where you had foreign central banks that loaded up on these big names. And I did a check. Let's look at the dollar relative to the Mag 7 index. And for 12 months, it pretty much followed each other, both up and down. And I said, okay, well, maybe foreigners are going to rethink their holdings of these stocks. Well, then fast forward just a couple of weeks, and then you get the tariffs. And then that sort of forced investors to not just rethink because of possible changing fundamentals of the Mag 7, but let's rethink our investment holdings in the entire country because of what's going on with tariffs and the approach being taken with us as a foreign country and a foreign investor.
Yeah, so there's a lot that happened, like I said, between mid-February. So one of the things you focused on, to your point, was can the earnings really validate valuation? And I know you were concerned about two of the names at the time, which was Apple and Tesla. Those are the two kind of you were a little bit concerned about. They were both facing their own headwinds separate from that. But when you look now, we can just look at the Mag 7 entirely. We can talk about Meta, Amazon, whatever. The earnings were better than expected, it turns out, in Q1, right? So a little bit, and much higher than the rest of the S&P 500. And I think their earnings account, for over half of the S&P 500 earnings. So it's still very concentrated. But I want to go back to the point you just made, because as we were leading up to the tariff announcement in early April, there was already things going on, right? Doge cuts going on. Where does U.S. stand, to your point, as a trade partner, even because there was always tariff news that was kind of coming. And it was going to hurt the dollar potentially, the debasement, which to your point played in the fact that how are people exposed to the dollar? It's through Mexico, so kind of fed on itself. So here we are today as we sit here. We've retraced it all. There's still a lot of uncertainty relating to taco, tariff, what do you want to call it? People want to trade through it or not. And we sit here. I think there's a disconnect, and that's what I want to get your opinion on, is the impact has changed the behavior. Forget about our trading partners. The impact of the tariff and this other stuff, I believe, has changed the behavior of private and public companies across the U.S. So we haven't seen that yet because that really wouldn't have happened in Cuba. So talk to me about now what the forecast is for the S&P 500 earnings, specifically maybe even 2Q. We're in conference season. So talk to me where we sit now in real time.
So I think that's an important question because with the S&P back to where it was mid-February,
Right.
You have to really compare what were the circumstances then versus the circumstances today. Okay, let's take earnings. We came into 2025, S&P earnings estimates were about $270 a share for this year. Now that estimate is down to $262, $263, with a lot of questions to even that number because the first 2 quarters of this year have been totally distorted by all this tariff stuff. You almost have to merge the 2 quarters together to really get a sense of what actually happened. And for the back half of the year, I mean, just put your finger in the air to see, because I think that's as best a guess as you're going to get. And that's just not me talking. It's companies themselves that barely gave guidance. And if they did, you can drive a truck through the guidance. And those that did give guidance, there's just more natural visibility to their business. We came into the year with the tariff rate on the rest of the world at about 2.5%. That went to, at minimum, the 10% baseline to 12.5%. Then, of course, the extras on China brought it higher, but now that the 10% may not actually happen because of the court case, but even though it's going to take months to figure that out, call it with auto, steel, aluminum, and some other things, you'll have a tariff rate of maybe 6.5%. Now, some people can say, well, it's not much different than 2.5%, but, it's still a 400 basis point increase in taxes on certain American businesses that would bring the aggregate tariff rate much higher than it was, and you have to go back many decades to get there. Take Doge, for example. I don't think people appreciate the extent at which government spending over the last couple of years, particularly out of COVID, was a boost not just to GDP growth, but to earnings and corporate profit margins. And that every dollar that's spent from the government ends up in the private sector. Now, whether it's efficiently spent or not, that doesn't matter, but it's still money spent being created out of thin air, aka borrowing money. So the one thing with the current budget that's being negotiated is there is a concerted effort to slow the pace of government spending. So while that is desperately needed for the sake of the finances of the U.S. government, it's going to have in the short term defined as the next couple of years, will be a fiscal drag on the economy. Then let's go back to the Mag 7. If I'm right, and we'll have to see, that the Mag 7 trade is over in terms of its leadership performance, and that investors are now realizing that, hey, there's 493 other stocks in the U.S., and there are thousands of stocks outside of the U.S. that I can buy. Well, we have tariffs that are higher, even though off the highs. Mag 7 may not be the same trade anymore, which made up 35% of the S&P in mid-February, and you add another 3 to get the top 10, which was 40%. A slowdown in government spending in terms of its impetus to the economy, and you're back to trading, and with the reduction in the S&P earnings estimates, you're back to trading at 22, 23 times earnings. So there's this major leap of faith that everything is fine, and never mind of the last couple of months. And let's talk about interest rates. 10-year yield is still pretty sticky around this 4.5% level, and we came into the year expecting a bunch of rate cuts. Now we're down to about 2%. But the Fed has made it clear that if they do cut, it's because more so potentially a rise in the unemployment rate rather than anything else. So it gets tricky up here, and I don't need to make calls anymore in the S&P because I just try to buy things that go up and avoid things that go down. I could care less where the S&P goes, but I think it's important as an investor to really compare the circumstances, like I said, of where we were in mid-February and where we are today, since the S&P is pretty much at the same levels.
So 2 things I want to take away from that and hone in on. One is even during the massive sell-off kind of in early April that we saw, retail flows were still coming in. It was amazing, whether that's an annual timing thing with 401ks and people reinvesting, whatever it might be. And the second thing, to your point, is employment. And we haven't really seen anything yet. Employment's been fine. It's definitely at the margin getting a little bit worse, but it's not your JOLTS data, which you give great information on a daily basis and build this mosaic, which is great. But here's the thing to the point you just made. You just tied in, I'm going to talk about the Fed here because there's 3% chance of a cut that's coming up here in a couple weeks here. I think there's going to be a big day that day. What do I mean? We're now Trump's getting more involved. You can see all he brought Powell to the White House, right, last week or whenever they actually met. He's basically highlighting inflation's down. No one's going to look at the numbers like you do and comprise, but it's not really down as much as you think. So let's fast forward to a couple weeks from now. If employment does start to deteriorate, I'm not saying this Friday's number is going to be a point of, deembarkation here or not, but it does. The market might be telling us that it has a Fed put in it because the one thing that would derail all of this is unemployment shooting higher, but inflation's kind of ebbed. Is that the Goldilocks scenario that everyone is just holding their nose and just hoping that happens here?
I think that's a great point and possibly a high likelihood why the market is where it is. I mean, there's a possibility on Friday because we've seen a lot of anecdotal news. We've seen it in the continuing claims data that the pace of hiring is slowing. I mean, it's just the natural corporate reaction when you see what's going on with tariffs to say, I'm just going to put a timeout on my hiring plans. I mean, you look at a lot of the regional manufacturing surveys, for example, and the comments are just littered with tariff confusion. And you're not going to expand your payrolls under that circumstance. So I would not be surprised if we saw a below 100,000 print on Friday. We'll get ADP on Wednesday. And that could definitely raise the odds of the Fed cutting interest rates. Now, we're locked in for 2, according to the Fed funds futures. Fed's definitely not cutting in June because Powell's not going to roll over for Trump. He can care less about Trump because Powell knows he's got less than a year left. And he's just more focused on his own legacy than anything. Now, that said, Chris Waller wants the job and he's all set to cut. He's going to find every reason to do so. But if there is a tick up in the unemployment rate, if you get a 50,000 print in payrolls, yeah, you're going to be talking all about that and the market may like it. Now, the one issue, though, is what we learned with the Fed's 100 basis points of cuts is that doesn't mean that the long end is going to accommodate where the short end is going to trade. And if the long end of the curve still wants the Fed to be tight because we're not out of the woods on this inflation story, well, maybe the long end is not going to rally to the same extent that the short end does. And maybe the yield curve steepens and a bear steepener and long end rates go up because they don't want the Fed to be cutting. Because if I'm on the 10-year, I want the Fed to be tight. And I still see the inflation risks. And so but I do think, yes, we're up here because everyone thinks the Fed is going to save us and soft landing and everything's going to be fine, Danny.
Right. And every meeting that we get past your point, there's only about, so he'll have 8 more meetings as Fed chairman or something like that, maybe 7 or 8. And now Warsh, by the way, is also out making noise that the Feds probably should be cutting also. So those two are jockeying. Waller and Warsh, I think, are jockeying for the job. I just think we're underestimating Trump's reaction when he says no, rates holding steady, and we're still waiting to see what's going to happen with inflation and is it, tariffs have caused anything. So I think that'll be a seatbelt moment potentially for the markets, but we shall see. So let's talk about the 10-year yield here and 10-year bonds, which I think is the be-all, end-all. It just is. It's Trump might be the straw that stirs the drink, but the 10-year yield is right next to it, and maybe a smaller cocktail, but Besson is there watching it. So we have this tax bill, which you just talked about, which they're going to try to jam through in some form or fashion, and then we have inflation expectations, et cetera. Where does the 10-year yield go? And, I had a guest on here last week who talked about 4.75% kind of is the main Cantro. Michael Cantro was on here, talked about what are your thoughts where it really starts to matter?
So I think it's important to really put the global bond market into context because I think it's not enough to just look at U.S. growth and inflation and come to some 10-year yield estimate. I think we have to understand that in 2001, when we had $18 trillion of negative yielding bonds, and you could argue hyperbolically that this was the biggest financial bubble in the history of bubbles, in terms of dollars, where you've had this asset class that was turned into liabilities for the holders of them, to an extraordinary level. And what we've seen since early 2022 is this 40-year bond bull market ended, and a rather sharp rise in interest rates, of course, as we've seen. So when I wake up in the morning, my first look is not the U.S. 10-year yield. It's the 10-year JGB yield. it's the 30 and 40-year JGB yield, because there is a flow through between what happens there, what happens in the UK gilt market, what happens in the US Treasury market. I'm just pointing out three highly indebted countries where seemingly their bond markets start to correlate. And remind people that in 2023, when the US 10-year yield was at 360, in my opinion, the catalyst that drove it from 360 to 5% was the BOJ essentially ending yield curve control. They were directly connected. It wasn't just all of a sudden in summer 23 we started worrying about U.S. debts and deficits that drove the 10-year up to 5%. It was, wow, the world is changing. We are ending not only zero interest rates in Japan, but yield curve control and this global yield suppressant of central banks with their foot on the neck of interest rates. Like, this was over. This was like sort of the finality to it, because all the other central banks were raising interest rates in 2022 and ending QE and doing QT in response to the rise in inflation. Japan was finally throwing their hat in the ring in terms of tightening. And I don't think that this sort of bear market is just over in a couple of years. I still think there are more stories to this chapter. I think that inflation is not just magically going back to 1 to 2% and staying there. Now, we're gonna head to 2%. We're sort of there in the PCE. Rental growth is going to slow in the back end, but once you get to the middle of next year, rent growth is going right back up again. So if I look at over the next 5 years, where I look at the TIPS market that's pricing in 2.25%, 2.5% inflation, I think that's just sort of la fantasy, and that 3.5 could be something that's more likely. So this is sort of a bid underneath long-term yields. And yeah, the Fed can cut again, but what if we just, like, as I said before, a replay of when they cut 100 basis points? And if the market's not comfortable with the trajectory on inflation. And, I know debts and deficits do matter now. It matters because we're all talking about it. For 40 years, people brought it up, but it never mattered. But now I think it really does matter, particularly in the U.S., because we rely on foreigners still to buy our treasuries. Not to the same extent that we did, where 10 years ago, foreigners owned half the U.S. Treasury market, and now they own about 30%. They're still incrementally buying, but the percentage of their purchases are shrinking, and now you have weakness in the dollar. To me, a very interesting moment for the Treasury market was the day, or the 2-day time frame, when the Taiwanese dollar went up 8% within 2 days against the US dollar, because people woke up to the fact that Taiwanese insurance companies have been loaded to the boat in US Treasuries, and they basically gave back multiple years of interest income in 2 days on the currency. And that I don't think people appreciate that if you lose that foreign flow into US assets, how on the margin that could have an impact, irrespective of what the Fed does, irrespective of where US inflation and growth goes. And that we have to be looking at all global bond markets. And one last point, Japan is the biggest foreign holder of U.S. Treasuries, as we know. And if the JGB market all of a sudden becomes more attractive than the U.S. Treasury market, well, hey, I can get yield in Japan, and I don't have to take any currency risk.
And I think in that summer of 23, I actually had an episode called Janet Jackson Control. And I sang yield curve control, and that was a big moment. And it's always currencies, right, that cause something, to your point. It's always the kind of the symptom of something else going on. No one knows Japan better than you. You follow it. And the really interesting about this recent market rally, and we're going to talk about gold, obviously, is all the other signs feel like it's stressing. The yen is back, as we see it here, 143-ish. I believe it's strengthened. So people, when it goes down, when you see it go down, it's strengthening versus the dollar. There's a level where that's a problem, obviously. Their rates, to your point, they had a good auction, I believe, in the last few days. So things are okay, but there's always expectations. Why does it matter? And again, we sit on the show, we try to help people and educate them. A lot of brain damage trying to understand it, and then it matters for a day or two, and then it doesn't matter. So when does it start to matter on an ongoing basis that becomes a little bit more important here in Japan?
Yeah, that's an important question to try to figure out. So we had in Japan a week 30-year and a week 40-year auction over the last couple of weeks, and then to your point, we had a very good 10-year. But part of that was questions about whether the BOJ is going to continue to the same extent with their asset purchase reduction. That's been another underlying thing here that's been flowing into the JGB market. Is here you have this central bank that sort of was the architect of QE and zero interest rates, stepping back even from their own market where they own half that market. When it matters, it's one of those things that you don't know until it does, and eventually it will. But I'm watching that market. I'm watching how it flows into the European bond markets, particularly the gilt market, which has shown much more sensitivity to worries about debts and deficits, and what's going on in global bond flows. But to put another number behind the foreign flows into U.S. assets, and this I'm relying on Torsten Slock for this stat in one of his charts that he comes out with every day, between U.S. stocks, U.S. corporate bonds, and U.S. treasuries, foreigners owned about $30 trillion worth. And I'm not saying they're necessarily going to sell, even though I think they are trimming around the edges. But if they just add less to those holdings, you need to offset that with something else. And I just think that these are all the different markets that people should focus on. They shouldn't just wake up and say, okay, the Fed's going to cut and everything is going to be fine. Understand that the global world is very intertwined, and the world owns a lot of U.S. assets. And we have to focus on where that money is now going to go. Well, we know where it's going. It's going home. And you can see that in a lot of these international markets that have just been extraordinary year to date. Whether it's the Hang Seng, whether it's the German DAX that's up more than 20%, or the Italian stock market or the Spanish stock market. I mean, investors are speaking with their money and saying, hey, U.S. was great for all these years. It was just exceptional. And maybe there are other things that I should be focusing on here.
Yeah, so gold is the other byproduct of all of this in terms of central bank incompetence and or worrying about debt to GDP levels, which we've never had during, quote, what could be a cycle coming here. So talk about gold, what you watch. Obviously, you watch the price, but you're watching the flows and where they're going. And it's held up pretty well. And we had a pretty big move here from kind of the high 2000s to 3,500. We've retreated. We've kind of holding in. It's another one of the things that I watch. Tell me, how do people feel about geopolitics? How do they feel about the dollar debasing and so? So where are we in the gold, and how does that factor into everything here?
So I'm going to go back in perspective on that market too, just as we did with bonds, because I think it's important because, this gold bull market, which has really been started in 2000 off the $250 low when the Bank of England was selling all their holdings. Then it was interrupted after the peak in 2011, went through a bear market, basically got cut in half, and then, interestingly enough, bottomed just as the Fed was raising interest rates. So fast forward, and this bull market has sort of gotten another set of legs. And those set of legs really started in 2022 when the US and the EU, of course, froze half of Russia's central bank reserves, and holders of US assets realized, oh my, if it happened to them, it can happen to me. I mean, you can just imagine Xi Jinping's face when he heard that news. And he realized, wow, we have more than $1 trillion worth of U.S. treasuries. Maybe we should not own so much. And if we do own them, maybe we should own the short end of the curve and not the long end of the curve. And maybe we should own more gold. Maybe we should back our own currency with something more sort of less volatile and more important than other fiat currencies. And the bid for gold over the last 3 years, it's been more than 1,000 tons a year from central banks. And the interesting thing about 3,300 in gold is we're really just back to the inflation-adjusted peak in 1980 of about this level when gold peaked at 850. Now, granted, that was sort of a parabolic peak, but just some perspective that we're just keeping up. And you look at silver. Silver, its nominal peak was $50 in 1980 and 2011. Platinum, which is another precious metal that I really like and we own here, that's down 45% from where it was in 2011. So even if with this big move in gold and even off the lows in silver, for example, I still think there's a lot of upside. And people have realized, when I say people, particularly central banks and other global reserve holders, the importance of owning this asset. And when we look at the dollar will always have sort of its dominance in terms of its use in transactions or its standing in one central bank reserve pie, where 25 years ago, the U.S. dollar was about 70% of central bank reserves. Now it's like 58%. I think it can go to 45 to 50 over the coming years. It'll still be a dominant holding. It can still be a reserve currency, but foreigners are realizing that they can have less of it. And certainly the tariff thing that pissed off the rest of the world, they're more inclined to facilitate and quicken the pace at which they own less dollars. And gold is just a huge beneficiary of this transition.
Bitcoin, I guess you could argue as well. I know you're not a Bitcoin bull per se, but you acknowledge that people view it as digital gold to a degree, and it's hedging also all the incompetences of potential global central banks. So two other sectors I want to get to that are very cyclical traditionally, that are just horrible right now. It's the energy sector and the housing sector, right? And we know why the housing sector is suffering because of rates and all that, mortgage rates specifically. But let's start with the energy, because it's been a huge tailwind for the consumer. Oil prices having hovered here in the low 60s now for a pretty long, few months here and drifting lower. Where we sit there, because I make the argument that if you believe we're not going into recession, to investors out there, I don't know how you don't, one, not say you have to own oil, but you want to own the energy stocks. So I know you're a bull on them to a degree. So talking about energy, and then we're going to get into housing.
So yes, with the disclosure that I'm very bullish on oil and gas stocks, and we're long them. The stocks themselves, having exposure to natural gas, has allowed them to mitigate somewhat the lower revenue that they're getting from crude oil. Natural gas is approaching 3.5. Remember, we were sitting at 2 for a while, where obviously oil is down. But what I think, and I find really interesting right now with the price of oil, first of all, I think price of crude oil is dirt cheap. I mean, that it's at $60 in nominal terms. On an inflation-adjusted basis, it should be much higher. And historically, I've always looked at the gold-oil ratio. And oil is hugely cheap if you look at just that ratio in terms of how many barrels an ounce of gold can buy. And I know there's obviously a lot of worries about OPEC. They're slowly beginning to take back their 2 million plus barrel a day cut. And they're adding, just for the third tranche, so to speak, they added 411,000 barrels a day. But I think what's being missed here is that the U.S. shale is responding in kind as well on the flip side. And that over the last 15 years, U.S. shale has really been the global swing factor when it came to production. In terms of oil production growth in non-OPEC, U.S. shale has dominated. It's been like 80+% of being the production swing factor. And now all of a sudden you have the U.S. rig count capturing both onshore and offshore is down to the lowest level since 2021. It's fallen sharply over the past 5 weeks. And geology-wise, and Diamondback Energy said this, and some other energy CEOs talked about, maybe the peak in U.S. shale production, not just because the price is low, but because the geology is not there anymore. Now, I never want to discount technology. Maybe tomorrow we find something else. I'm just talking about what is being seen right now, and that maybe the Permian is the last major basin that's seeing some production growth, but I've seen some reports that even that is topping out. So if U.S. shale, we lose that as that swing factor in non-OPEC supply, and that U.S. oil production in totality stays at this 13.5 million barrels a day, to me, crude oil at $60 is a screaming buy. And what we've seen with a lot of these companies, because of the help of natural gas, is that they're still highly profitable. And if you can buy a commodity stock and a company that is making money at possibly the bottom of a cycle, well, you can imagine the money that they're going to make if oil just gets back to $80, let alone the risks meaning for the consumer, to your point earlier, but to the benefit of the oil companies. Oil can easily go back to triple digits.
And one other point on that is all the M&A that has occurred over those last 4 to 5 years has fortified the balance sheets, to your point, of these companies. They're not forced to drill just for cash flow to pay off debt. Their balance sheets have never been better. And so no one's going to tell them to drill, baby, drill if they don't want to. Plus, we're entering hurricane season. But I think it's really interesting because the sector itself is so underweighted still that you can get a flat S&P and a huge rotation into energy, and if you don't look underneath what's going on. So I make the argument, I think you agree, that if you are okay on the economy, you think the economy is going to, then if you don't own oil, honestly, energy is so attractive.
Yeah, I think it's 3% or less of the S&P. Right. So when we talk about maybe a transition phase in the market, right, maybe outside of the Mag 7 dominance, and you need to find other things to buy, to me, it's an ideal group.
Let's talk about housing. It's a large percentage of GDP in terms of housing starts, construction, all the stuff that kind of goes into it. If you didn't look at anything else other than housing, and you said, "Okay, where's the market? Where's the market?" Because you see where rates are, housing makes sense. But talk to me on how this is unlike any other cycle. And I think I'd love to get your opinion on this. COVID really changed kind of the cycle for housing in general anyway, in terms of people working from their home. So give me an idea where we are in this cycle here for housing.
Well, I'm going to tie this back to the early 2000s and just argue, and you saw it firsthand, how the Fed through policy, turned the housing market upside down. And it's funny because when you look at the Fed's goal is stable prices, but stable monetary policy is of course not what we saw for a 20-year time period. And we saw obviously the boom and the bust, and then the Fed just went haywire in response to COVID with all the mortgage-backed securities they bought and sending rates back to zero, and mortgage rates going down to 2.5% again. Like, you thought that we would never see that again. And then all of a sudden interest rates go vertical in 18 months. And that just turns the natural sort of chain of transactions where you get that first-time home buyer that buys from an existing one who wants to trade up to another one. And the new supply market sort of fills in the gaps of the existing market and absorbs new household formation and so on. It's like the laws of supply and demand were just totally busted. And now we have this sort of frozen market. But what I'm beginning to see, though, is the markets that the new builders thought that they can keep on building to sort of supplement the lack of inventory in the existing home market, that market's beginning to soften, particularly in Florida, which I know you reside. Now, some of that is, of course, higher costs, like on the insurance side and other reasons, but some of the hot markets are now cooling. On the flip side, some of the supply-constrained markets, like the Northeast and California, where you just don't have the ability to just build, those markets are still pretty tight. Prices are still going up, but they're beginning to top out as well. Now, there is a plus to a housing market slowing down because maybe it gives that first-time home buyer a chance. But that needed supply to really improve the affordability situation for that first-time buyer, it's not there yet. And I hear people very simplistically saying, oh, the Fed needs to cut rates because we need to help the housing market. But not understanding that, let's just say the 10-year yield went from the 30-year mortgage rate from 7 to 6. Yeah, that would be great, but that extra demand would then further boost housing prices. So a boost in housing prices would then all of a sudden offset the benefit of lower mortgage rates. What the housing market needs, it really needs the baby boomers to downsize. We need a flood of existing home supply to hit the market in order to cool home prices, which then can join lower mortgage rates. And that's what you need to improve affordability, not just, the Fed needs to cut rates because that would help the housing market. That's just way too simplistic.
I guess if the Fed did cut, the one area it would help is HELOCs and people being able to take equity out of their home at a lower rate. So there is a lot of built up equities,
yes, for sure.
Which goes to the mindset of, when the Fed does cut, there could be positive implications in the market and everything else like that. So, all right, so another area that you and I have talked about is sports gambling. And we haven't actually talked about it in a while, you and I. And fascinating thing is going on with this Kalshi. And I don't know how up to speed you are on this, and I'm sure you are. And for people out there that don't know, these event contracts are basically governed by the CFTC and not state regulated, as DraftKings and FanDuel have had to go through all those iterations of all that stuff. And now they're in California and Texas, these event contracts. And so
where gambling is illegal.
Illegal, right. So we're seeing this huge arbitrage. And so the theme had been on DraftKings and FanDuel, and we'll throw in Genius Sports, Genie, which I follow closely, has been this macro growth will outweigh any type of consumer slowdown, et cetera. There's a monkey wrench in here now, and I know it's not a huge number, but for sophisticated gamblers, of which I would say I still lose, I'm sure, but sophisticated in the way of knowing where to find the right odds. I can go on Robinhood now, right, in certain states, and now arbitrage stuff. That's the sweet spot for DraftKings and FanDuel, has been taking advantage of in-game live wagering at Mets. Give me your thoughts on that. I'm putting you on the spot here. I don't know how up to speed you are, but it's amazing how a policy like that or lack of enforcement can change.
And then we can add the Illinois tax increase.
Yeah, the went up yesterday to 50%.
Which is the similar mistakes that politicians are making in cannabis, where you're just lighting a fire under the non-regulated market and the illegal market, and all you're doing is damaging the businesses that you're trying to derive tax revenue from. And anyway, they're passing it on to their customers anyway. I mean, I think the what Kalshi has sort of created and differentiating themselves from a legal standpoint on the gambling end. Like I feel like regulatorily that needs to reconcile between the event bet. Yes, are they going to win? Yes or no, as opposed to a prop bet or a one with a spread or whatever. I feel like that is an unsustainable regulatory situation that needs to be fixed. And either Kalshi starts to apply for regulatory gaming licenses,
No
or
chance.
I agree, no chance, or the existing gaming companies start to get into the event contracts, and because the last thing they want to do is cede market share to this other side. Like, I just don't see this as being a sustainable situation.
Yeah, I don't think it is either, and I think they're hesitant, the traditional gaming companies, to do it, knowing that the states that they're in could somehow cease and desist on them if they were to start doing event contracts in other states.
But I knew some AGs, though, were pushing back against Kalshi because they don't want to obviously disrupt their own gaming companies.
For everyone that doesn't know, so Donald Trump Jr. is an advisor to Kalshi. The current nominee to run the CFTC is on the board at Kalshi, of which he says if he's nominated, he will leave the board. But I still feel like there's enough influence there where nothing's going to happen to them. And they're going to get into player props. Trust me. Like, it's gambling. I mean, I know gambling when I see one. It's gambling. So it's interesting. So I'm watching it closely and think about the customer acquisition costs, the head start now on these event contracts in California and Texas these companies will have. So remains to be seen. All right. Before I get into my Belmont picks, which we're going to do here, other than Diamondback Energy, which you talked about, give me your favorite picks right now. We'll just do longs here. We don't need to do shorts here with all the stuff that we've kind of talked about. Run through those before I give you my Belmont picks.
So on the oil and gas side, to a theme of investors investing more internationally, BP and Shell, because of where they're domiciled, and also because they sort of strayed from the oil and gas business into this renewable stuff, where the economics are just obviously not the same. They're trading at a fraction of the multiple of Exxon and Chevron. So I find both of those companies very attractive. BP obviously is being swarmed by activists. So I think there's a lot of upside in those two names. Natural gas, to me, EQT is the leader. I still think there's the possibility, and I have no idea when this gap closes. There's a massive spread between where natural gas prices trade outside the U.S. and where they trade inside the U.S. And if they were ever going to close that gap, it would more likely be U.S. natural gas prices that follow European gas prices, for example, rather than those gas prices following down to U.S. numbers. So I like EQT, and still a fan of the pipeline companies. Good luck building, a pipeline nowadays in the U.S., even though we do have some permitting and regulatory help from the Trump administration. Williams may start to restart the Constitution pipeline in the Northeast to provide some gas to New York and New England. But also, if I can include uranium in that energy mix, because uranium, which has had a great run here over the last couple of years, probably the easy money's been made from a stock perspective, but the theme is to me very large. And the interesting thing about uranium is that if you look at a nuclear reactor's cost structure, the price of uranium is actually very small as a percent of their total costs. So the price of uranium can go up a lot, and utilities still have to buy it. And they can still buy it without necessarily negatively impacting profitability-wise their facilities. So to me, there's a lot of upside there as well.
Yeah, and that's a generational trade. So which names?
And wait, one last name in oil and gas. We talked about shale. So if shale is actually slowing down, well, oil companies need to find other places to drill, and that's offshore. So maybe the offshore game starts to improve. So we're long Noble, which is a rig company that has all their rigs offshore.
What name in uranium are you looking at?
So we're long Cameco is just the generic name, and then the Sprott product, URNM.
Yep, got it. Okay, good. Anything in the consumer land and retail that you fancy at this time? I mean, I know you track that
So
well.
one name that we own that's just been a complete dog, pun intended, it's Petco.
Yep.
But the demand for feeding and loving your dog or cat or other animals is still there. Petco reports earnings this week, so we'll see what they have to say. They're relatively new CEO that came from Five Below. So that's just a beaten up left for dead name that I think has potential. The retail environment is very tricky because you really have to be careful about what end of the customer you're serving. For the last year, and this is not just a 1 quarter or two. This has been almost for more than a year. Obviously the upper end consumer is spending with less fear than that lower income consumer. I went through with a hat tip from Vinny. Who
Yeah,
told me-
I saw VD. I figured
saw,
that was
yeah.
Vincent
So
Daniel,
because
yeah.
Vinny pointed out to me that MasterCard and the credit card companies presented at the Bernstein conference. So I went through the transcripts, and at least New American Express we know is a higher income consumer, and their business seems to be just fine. Now, travel has been softened a bit. We obviously see less people traveling to the U.S., but that traveler could still be traveling somewhere else. The restaurant business is doing very well. But then at the same time, I'm reading the benign comments from them. I read Campbell's Soup, who's telling us that their snacky business is down.
Right.
Now, maybe that's GLP. I don't know. But, they're seeing more people eating at home. And when you're eating at home, it's because you want to save some money from eating out. And when McDonald's is telling you that their business is soft for multiple quarters, that should tell you a lot about the lowering of the consumer. So if you're investing in a company that's touching the consumer, you still have to be very sensitive to what area of that income scale they're sitting at. And then that gets into, everyone debates where the economy is going. And I tell people who give me their recession odds,
Yeah.
I'm like, well, if you're going to give me a recession odds, you also have to tell me where you think the S&P 500 is going to go. Because if the S&P 500 is going to hang in there, well, maybe the economy can hang in there. But if the S&P is going to retest 4,800 and break down, and I'm not saying it will, but if it does, well, the economic outlook is going to look quite different at that level because of its flow through to that upper income spender
100%.
and CapEx and so on and so on.
Their massive wealth effect has been in this market. It's been self-fulfilling on the way up, and we've seen glimpses on the way down where things can just literally seize up on the services side. All right. Belmont Stakes this weekend, running at Saratoga again for the second year as Belmont rebuilds, and who knows, maybe another year in Saratoga. Interesting thing, it's the oldest race of the Triple Crown. So you got the Derby and the Preakness, and it's being run at 1.25 miles because you can't run 1.5 in Saratoga. It would be 3 turns around the track. So it changes the whole entire dynamic. So it would be an asterisk even if you won the Triple Crown. There is no Triple Crown this year. You had Sovereignty win the Derby. You had Journalism win the Preakness, and those two were actually running the Belmont. However, a horse that I'm a partner of that I own is Rodriguez. And when I was down at the Derby the day before, a couple days before, we scratched Rodriguez. So we had Citizen Bull, the one Rodriguez scratched. So he's rested. This horse has run 5 times total, has hit the board every time. And again, this is 1.25, so it changes the whole dynamic. So we are the 3-horse Rodriguez. So let me put my heart to the side, although money line, early morning line 6-1, I happen to like it. Sovereignty.
But I do, can I interrupt?
Please.
Quick? I do like when you say, before you look at the odds, you analyze the fundamentals.
I do. And it's funny, I did it. I knew
back into the odds.
I mean, I knew that Sovereignty and Journalism would be the 2 favorites here, right, just because but you want to look into it. So I fade Journalism here. It's the favorite. I would fade it because it ran Derby and it ran Preakness, right? And by the way, it had everything it had in the Preakness 3 weeks ago. I don't think it's going to have enough. Sovereignty ran, I always look to see where horses have run. It ran at Saratoga as a 2-year-old in a 6 furlong race. So people out there, 8 furlongs is a mile. So this is 1.25 miles. So consider it like 10 furlongs. And in that race, it came in 4th. Okay. But it was coming up and it was in the 10 hole and it was kind of ran to the outside, had enough. This horse to me rested, shipped to Belmont Park, by the way. I know this is not where the race is, right after the Derby when they said we're not running Preakness, has been in New York. Listen, 2-1 all day long on Sovereignty, but put it with the 3 Rodriguez. A couple others that are out there, like, there's Baiza, which everyone tends to like, which could hit the board. But I really think it comes down to 3 horses, and it's Sovereignty, Rodriguez, and Journalism. And I think Sovereignty, Rodriguez, a 2-3 exacta box is the way to go. So I'll be up there, hopefully cheering on, and look for us in the winner's circle for some reason.
That's noted, because I love the extent of your analysis.
Right, we'll see. We'll see. I'll do better on this sometimes than I do in the stock market. Well, Peter, thanks so much for coming on. You've been a great source of information. You can find Peter's book report on Substack, right? I highly recommend people subscribe out there. You're also on Twitter or X, whatever the thing is called. You're frequently around on you've been very generous with your time, both on the tape first iteration, on the tape second iteration, risk reversal. So you're a partner for us also. Peter, thanks for coming on.
Thanks, Danny. This was great and a lot of fun to do.